The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our Investors Observer members only workshop. So let's get started. This is our agenda today. We're going to look at a few charts. Not as many charts as usual, just because there aren't as many interesting things to say about charts as there are a lot of other times. We'll talk about a whole bunch of what else is happening in the stock market and the economy right now, and then the rest is time blocked aside for member-driven content, which means questions, stuff about the website, anything that you are curious about or want to see, let me know and we'll do it. You can put questions in the question box now. You can put questions in the question box at any point you want while we're going along today. I'll get to them whenever. You can also submit questions ahead of time. We got one ahead of time this time around. But yeah, put them together ahead of time and you'll get probably, a slide or two devoted to your question, and I'd like to say a more coherent answer. All right, with that, let's go to the charts. All right, so S&P 500 is looking, let's say, better than it was last time. 3 weeks ago, we were still pretty ugly in terms of, I think 3 weeks ago may have been about here. I'm not going to count it, but yeah. It was pretty ugly. It hadn't really hit anything that looked like it was trying to find a bottom, whereas now we kind of have this new line that I've added here today. And we've kind of been in a range and maybe breaking out today. We'll see. I didn't quite get to close. We gotta pull the charts before the market closes, but it's probably close enough in terms of where today is. But yeah, obviously there's a lot going on besides just what the charts look like. So, I'm not sure that the charts are particularly predictive at this point. The NASDAQ looks kind of worse from the S&P in terms of just where it is compared to the top. It's down a lot further. It also looks kind of like it found a bottom. This is not a new line here. This is a line that existed from back here, so it did find some support eventually, and we'll kind of see where things go from here. The Russell is, I think, maybe more interesting, just in the sense that it had this big slide to start the year and then has been kind of going sideways basically ever since, whereas the NASDAQ sell-off started maybe the same time, maybe a little bit earlier than the Russell. And the S&P 500 at least hit a high more recently, but also, here we go. The Russell was basically in this range for all of 2021, whereas the S&P and NASDAQ posted pretty solid gains. All right, so the S&P 500 versus the equal weight isn't really telling us a lot right now in terms of they're pretty well lined up, and this is pretty much not surprising. It turns out when you have volatility, particularly sort of volatility that is, let's say, exogenous to the market or financial system, right? So volatility from something coming outside the market, correlations get pretty high, which is to say, basically either all the stocks are up or all the stocks are down. And that isn't entirely true, as we'll see in a second, but it is more true in times of high volatility than in times of low volatility when, different stocks are doing different things. All right, and then our last chart today is this growth versus value chart I like to look at. It's not that the value, which is the red and green line here, has done well necessarily. It's just the growth stuff has done poorly. It's still up over the last 12 months, but on the order of 4% as opposed to 10% for the value stuff. And that's kind of not surprising given that given that interest rates are rising, things like that, you would expect the sort of more speculative things, which is the growth bucket, to kind of come down a little bit. All right, so what else is going on? We got Russia and Ukraine. Obviously, that's been the big headline. Lots of volatility related to that. Also in stocks, also in commodities, which is maybe where it's more important, because I think, if we go back to our growth versus, our S&P 500 versus the S&P 500 equal weight chart, right? The reason I like to look at that is you got those 5 giant companies at the top and then the other 499, but there's not no impact to Google, Apple, Microsoft, etc. From a war between Russia and Ukraine, but there's less than there is to lots of other people, and probably less than there is to the average American, just because the commodities prices matter. Yeah, commodities prices, it turns out, matter a lot to people and some companies that aren't software companies. So that's essentially what's going on there. Yeah, China ends up being an interesting wild card in all of this. They seem to be trying to sort of play both sides in terms of Ukraine. They joined in on some of the sanctions. They're also buying some Russian oil. They're not. Yeah, it's China. They have their own. They're not particularly closely aligned with the West or with Russia. I'd say they're probably a little closer to Russia than they are to the West, but they're clearly playing their own game here as opposed to being clearly on the side. They could take the opportunity to threaten Taiwan while the rest of the world is, kind of distracted. That would obviously be very bad for stocks, I think particularly the tech stocks, because, so much tech stuff happens in China and then also in Taiwan. I think that would be pretty bad for all of that, in addition to, all the other reasons a war between China and the rest of the world would be bad. But also China's economy is not doing super great. They're locking down tens of millions of people in pursuit of a zero COVID strategy. And also we talked several times last year about real estate firms that weren't doing well. It turns out their real estate firms still aren't doing well. There have just been other headlines. So all of that sort of paints an interesting picture, because the COVID shutdowns likely mean more shortages of stuff in the U.S. Right? The Shenzhen is closed, so like iPhone factories, things like that, not happening. China has done, Apple has actually done a pretty good job of seemingly not being as stressed with shortages of either semiconductors or other things as other companies have. I don't really know exactly what to attribute that to, other than maybe better management. They're making all their own chips now, so that's maybe some of it. But they're still making chips in Taiwan and assembling things in China. So it's interesting that they have managed to avoid some of the problems that some other companies have. But yeah, so potentially more shortages of stuff, but the economic slowdown generally, both in those shutdown areas and the rest of China, potentially takes some pressure off of commodity prices globally, right? Like certainly if you get a slowdown in construction in China, then steel and some other commodities that have gone up in price, maybe there's less pressure there. Probably less pressure in the energy market also if you get a little bit of a slowdown in the Chinese economy. So there's sort of a couple of different things going on there in terms of, right, like some things that are maybe good for the inflation picture and some things that are maybe less good for the inflation picture. And then, interest rates and inflation are the other sort of big story right now. Obviously, the Fed finished meeting a couple hours ago. It's interesting to see the shift in the dots if you're into that sort of thing. Definitely they've moved away from transitory and now expect inflation to be above 2% into 2023, with interest rates to be near 2% by the end of 2022, which implies, if you think, if the unit of hikes is 1/4 of a point, which is what they did today. It implies something like 8 hikes this year, which I don't think they even have 8 meetings. So maybe some of those will be 50. They can also do balance sheet runoff in terms of either, when bonds expire, it frees up a lot of cash. They can either roll them over or they could not roll them over. They could also just sell some stuff into the market if they felt like they needed to. The tricky piece to all of that is, right, nothing the Fed is going to do is going to fix any of this stuff up here, right? So yeah, right. Like there isn't an interest rate that, gets wheat flowing out of Russia and Ukraine to the rest of the world again to help with food prices. There isn't an interest rate that solves the COVID problem in China. Right. Those sorts of things don't really exist. Right. So everything else, it gets pretty hard to figure out. But it's interesting to see how much the Fed changed their message and, if not explicitly said that they were wrong last year, pretty implicitly have said, hey, we maybe let this get a little hot in the sense of how much the dots and other projections moved for this meeting. Oops, sorry. All right, that is that one. All right. Sectors that are hot right now, energy remains at the top. Even with gas or oil prices coming down a little bit. Thermal coal is still at the top. It's sort of an anomaly because it's a very small sector with only a couple of players. Oil and gas exploration and production and drilling. I would kind of expect to see the refiners start to show up here pretty soon, just given that oil prices have come down and gas prices have not. That difference in price between the sort of crude price and the price at the pump is what is known as the crack spread. And so when that spread gets wide, obviously somebody is making money, and usually that somebody is the oil refiners. So you might start to see them show up here fairly soon. These ratings are, by the way, the Investors Observer short-term technical score, which basically is, what sectors have the best looking charts over the last month or so. And we'll show you where to find this on the website in a second. Secondly is utilities, which again, I think speaks a lot to people's uncertainty. Utilities tend to be a good play in uncertain markets. Also sort of interesting is that the gas utilities, which were on here previously, disappeared. Presumably natural gas is an input there, and so you got rising input costs, and in a lot of cases you got some regulations about how much and how fast you can change rates, so that kind of makes sense. Real estate is next, residential, industrial, specialty. Specialty comes to the top here over, I think it was retail that got knocked down. And specialty REITs are basically everything that doesn't fit in a different bucket. So it's like, it could be the property owners of cell phone towers, it could be timberland, it could be any number of things that don't fit into the sort of, residential, industrial, retail, or other commercial kind of space. I think there's also some healthcare. Healthcare is maybe another special REIT category. So yeah, this is again not surprising, right? It's a relatively safe place. It throws off a dividend. Also, the real estate market remains pretty hot right now. Office space, maybe the outlier there, but even then, I imagine that's probably getting better than it was several months ago. Financial services, financial data and stock exchanges. Yeah, guess what? They do really well in terms of volatility, right? Like everybody wants to know what's going on with those things. So you had growing economy, you got some volatility, financial data and stock exchange, they're going to do pretty well. Regional banks is, again, a story about growing economy, right? Like the regional banks in particular, they don't have big trading arms. They're not doing a ton of like equity underwriting or derivative sales or any of the stuff that your JP Morgans and your Citigroups and your Banks of America make a lot of money on. Regional banks are basically doing a ton of small business lending. So if they're doing well, it typically means the economy is doing well. And yeah, diversified insurance, that's probably sort of an interest rate play. If I had to guess, I don't think there's been a lot going on otherwise, but insurance, an insurance company, if it's well run, your premiums paid minus your claims collected should basically net out, and where an insurance company really makes a lot of money is basically investing the money between collecting it as premiums and paying it out as claims. So rising interest rates tend to do better there because they're not playing the stock market or running some sort of weird derivative strategy. Basic materials is new to the list. They bumped off I think industrial. And yeah, this is kind of no surprise given the Russia-Ukraine thing. A ton of aluminum comes out of Russia. Steel and coking coal are also just sort of probably travel alongside. I don't know exactly how much steel or coal come out of Russia. And there's a decent amount of steel that comes out of Europe that probably is at a premium now just because it's an expensive energy proposition. It may get just more expensive to make steel, and coking coal is an input to steel, is basically what that is. And yeah, you can find these anytime you want on the website under sector and industry. You can see sorted by any one of our 7 scores. I like to use the short-term technical for this presentation just because I feel like it gives a sort of relatively up-to-date look at the last, like I said, month or so. I think it's good to sort of keep track of things on that way, especially for something that happens once every 3 weeks, like these presentations. All right, so we gotten a couple of questions. None were specifically necessarily about the we're specifically for the webinar, but we have gotten some questions about this through our normal support channel, so I want to talk about it for a second. Basically, there's been some concern recently about Chinese stocks being delisted, and what you can do if that happens. And so basically what's happening is all companies that list in the US are required to have their audits inspected. So, and this is Sarbanes-Oxley, which is a law that was written after Enron collapsed, because it turns out the company was in cahoots with their accountants in terms of cooking the books. And so now not only do you have to get audited, you have to get your audit inspected or reviewed by a accounting board. And yeah, the Chinese companies don't do that. And so in 2021, something called I think it's this terrible HFCAA acronym. I think it stands for Holding Foreign Companies Accountable Act. Is designed to kind of try to push the companies to get those audits inspected. And so the first step of that is the SEC publishes a list. They have started publishing that list, I believe, earlier this month. And then companies will get added to the list as they report uninspected quarterly financials. But the delisting won't occur for 3 years. So you're looking at 2025 in any case. That is HFCAA delisting. There are lots of reasons they could be delisted between now and then, both company specific or the China stocks as a group. But yeah, so there's some chance this will get worked out. There's some chance it won't. It seems that now, like, it's essentially a policy in China that, we're not sharing these audits outside of the country. There was one company, Luckin, the coffee company, that it turns out was just straight up lying about their revenue. And so they got delisted, but I think they're back now. They got delisted in 2020 or 2021 for this kind of thing. So this sort of rule is hopefully designed to sort of prevent that. So yeah, there's some chance that China will allow it. There's some chance, I guess, the U.S. gets off in their stance. There's also a chance Chinese ADRs could be delisted for other reasons, right? We just talked about China and Taiwan. I think we've all seen what happened with Russia and sanctions. A similar thing could happen with China, in which case I would guess trading in a lot of Chinese stocks would suddenly stop. A lot of these companies have shares that also trade in Hong Kong, and so the ADRs, which is what trades in the US, is they're frequently convertible at some ratio. So there is some, if it gets delisted in the US, you can convert to, I looked at Alibaba yesterday and they explained the process for moving your holding from an ADR to the Hong Kong exchange. But my recommendation here first is going to be ask your broker. Not every Chinese company has the same rules about how to move those listings back and forth. Your broker should understand that. Also, not necessarily every broker gives every account access to every international market, right? Like just because you have a brokerage account doesn't mean you can necessarily trade stocks in Hong Kong. So that's probably a thing to consider. And then I also have some sort of other questions about right? Like before you go and convert your holdings in the US to holdings on the Hong Kong Stock Exchange, right? Like I just have some questions about like, why is it that you should ask yourself in terms of why is it that you as an investor feel you need to own shares of a company that won't share its audited financial statements? Right? Like that seems like an interesting question. You certainly don't need to tell me, it's your business. But I tend to stay away from companies that resist transparency regardless of the reason. Also, the Hong Kong market is controlled by the Chinese government, which is authoritarian and communist and all the things that go along with that. So is that a set of risks that you're comfortable with? And then also presumably as an American investor, presumably if you're here listening to this, how much money do you expect to flow out of China and into your pocket, right? Like most of these Chinese stocks aren't paying dividends or buying back shares. There's no real return of earnings to the U.S. investor. Yes, the stocks went up for a while, but that was largely on valuation. There hasn't been a lot of capital outflow. And again, right, with all the things I just said about the Chinese government in terms of being communist, authoritarian, how much money do you expect the Chinese government to allow to be transferred essentially from the Chinese citizens to American citizens? It's a question I feel like is worth knowing. And then also, I mean, get maybe a little bit political, as again, presumably an American investor, what motivates you to take all the other risks on this slide in order to help fund China's economy? Right, presumably you're doing it because of capital return, right? Like that's typically the reason to buy stocks is because you expect to get some money back. But given all those other risks, the one thing we can definitely say will happen is you're helping to fund Chinese companies by buying the stock, right? Like you're providing capital for that. Is that really a thing you want to do? So yeah, that's my note about that. If you're still curious about it, talk to your broker because again, right, like all those situations, every company is different. Each broker is also different in terms of how they handle that kind of thing. So that's really who to talk to. I can't give you a quick rundown of like, oh, you got to go to, just elect this at the next, shareholder meeting or whatever, and then that happens. It's much more complicated than that. All right, on to the questions. I see there's a bunch stacking up in the queue. That's great. I will get to those after this one. So this person said they were new to the platform and looking at the InvestorsKeyhole trades and saw an unusual option trade on Walmart. This is from the 7th of March. The strike is very far out of the money, a price Walmart has never been to yet. yet we said it was likely on the buy side. These contracts were bought at 18 cents and are down to 6 or 7 cents. Could you explain how we reached it likely on the buy side? Sure. So this is the Investors Keyhole notice here. There's 4 of these a day. One of them is about unusual options activity. One's usually an upgrade or a downgrade. One is about some sort of insider activity, typically buying, sometimes selling. And the other one is typically just about the news of the day. So this first paragraph here is essentially the what's happening. So in this particular case, the April 165 calls moved 2,750 contracts against open interest of 38 contracts. So let's stop and define some terms here. So open interest is published by, I think it's the OCC, every day. It is essentially how many option contracts are open as of the start of trading that day. So it doesn't change during the day, but it will change the next day. So if you see 2,750 contracts move and there's only 38 contracts open, well, the most you could trade to close is 38. So if there's 2,750 that moved in a day, that's that's going to be opening contracts as opposed to closing contracts. And so then the next piece is this trade moved high in the bid-ask spread. So anybody who's traded options, or really if you traded stocks, you've probably seen that there's a bid and an ask. And there's usually some difference between the two. For Apple and Microsoft and things like that, things that trade a ton, it's usually pretty tight, a penny or two. The less things trade, the further apart those get. And so what happens is, right, there's somebody in the market, in options even more than in stocks. But in stocks, generally, you're trading with a market maker also, right? And the market maker is just there to provide liquidity, right, to help you make a trade. So they're saying, yeah, you're here to buy something, you're here to sell something, whatever. I'll take it off your hands, and then I'll worry about who to flip it to. And the way they make money is by essentially the difference between that bid and the ask. So the bid is the highest offer to buy, and the ask is the lowest offer to sell. So the ask is higher than the bid. There's some difference in between. So if you're the market maker, what you're going to do is buy at the bid and sell at the ask. If you're everybody who's not the market maker, you're going to sell at the ask and buy at the bid. And so if the trade is moving high in the spread, that typically means that it's going to be buying. Because the market maker wants to charge a higher price. It may not be actually at the ask, but it may be somewhere close to it, right? They may fill orders for lower than whatever the standing offer on the market is. And if things move low in the spread, that a lot of times is an indication of selling, because that's where the market maker wants to fill, sales is lower. So that's how we arrived at likely on the buy side. And yeah, the fact that the stock has never traded at that price doesn't really matter, right? Like, it's a bet the stock will go up. That's why people buy out of the money calls. And yeah, the other thing is, right, so here's our trade, suggestion here is the April 120, 125 bull put spread for at least a 25-cent credit. So this trade makes 5.25% in a couple weeks, as long as Walmart stays above 125, which it's in the 140s or somewhere. So it seems pretty comfortable at this point still. So yeah, we try to make a trade that's in a similar direction, right? This trade has a bullish bias, but it doesn't necessarily require the stock to move. So essentially what's happening here is the guy who bought all these option contracts at 18 cents is just getting killed by time decay, whereas time decay actually helps the credit spread that we made here. All right, that's the end of the slides. Let's go back through the questions. All right, so Joel says, I see you say energy is up, but for the last few days, it seems like it's dropped quite a bit. Devon Energy specifically. Yeah, so oil prices are down actually in the last couple of days. Over the last month, they're still up quite a bit. In the last couple of days, oil prices have dropped. And the reason for that is this China lockdown, and some other things, some seeming maybe, there allegedly talks between Russia and Ukraine that are making progress. Also, I think probably the prices just ran up a little bit too high, and then they tend to correct a little bit. But yeah, crude is traded under, or yeah, the onshore, which I think Devon Energy is mostly onshore U.S., has traded back under $100, it being pretty comfortably above $100 for a couple of days. So that's what's happening there. Right. Richard says, I tried to take a screenshot and it doesn't seem to work. I don't know what you're trying to take a screenshot of, Richard. If it's the workshop, it's being recorded, and we'll send you a link to record it tomorrow, or to watch it on YouTube tomorrow. You can probably take a screenshot of that. There may be something specific to GoToWebinar that won't let you take a screenshot. If it's not something in the GoToWebinar software, I don't know what to tell you there. All right, so Gary said, explain bull put spreads. So sure, yeah, we got this example right here, in fact. So when we say something like, look at the April 120, 125 bull put spread for at least a 25-cent credit, what you're gonna do is, well, you're gonna figure out how to enter a spread order in your brokerage account, because you want to enter, it's going to be two things you're going to do, and you want them to happen at the same time. You don't want to have, like, you don't want to enter two different trades and then hope you get the price you're looking for. You want to enter one trade and one price, and then either get it or you get none of it. You don't want half of the trade. So that's the first thing you're going to do. And then you're going to, right, like we give it all to you here. So April 120, 125. And if we just say April, it means the sort of standard monthly option contract. In every case, except for this example, it will be the one that is on the third Friday of the month. April of 2022 is weird because the third Friday of the month is the 15th, which also happens to be Good Friday. And so the market is closed for Good Friday. And so the standard monthly option contract actually expires on the 14th. Which is kind of weird because it's not even in the third week of the month. It's the second Thursday instead of the third Friday, which is weird. But yeah, that's a weird outlier. But yeah, so if we don't specify a date and just give you a month, it's the one on the third Friday. It's also typically, most brokerages are still marking option contracts as weekly, or I think there's still some quarterlies, but yeah, it's also will be the one that's not marked as weekly. So then you're going to buy the April 120 and sell the April 125 for a net credit, in this case, of 25 cents. That's the whole thing, right? Like, so it's a spread, it's a credit spread. April, buy 120, sell 125, and it's always going to be, for a bull put spread, it's always going to be buy the lower one and sell the higher one. And then for a net credit of 25 cents. And so the net credit is a limit order. So you might get it for 26 cents, you might get it for 30 cents, you might get it for 25 cents. You won't get it for 24 cents or like 10 cents. Because, yeah, you want at least 25 cents. 25 cents or better, not worse. And so then, yeah, right, we say the trade is a target return of 5.26%. The return is calculated here because if everything goes according to plan, what happens is Walmart is above 125 at the close on April expiration. We keep the 25 cent per share credit. The options disappear. They're out of the money. They expire worthless. So that's the ideal outcome. But we do have some risk here, and that risk is the difference in strike prices, in this case $5, less the initial credits. The most we can lose on this trade is $4.75 a share. And so 25 cents over 425 is, or 475 is 5.25. And the downside protection here, this 11.33%, that is the difference between the stock's current price, 140.97 at the time of this writing, and that sold strike price of 125. Yeah. All right. Aziz asked, how quickly or often do the listed option trade ideas change under each stock? So yeah, all the option trade ideas except for the Investors Keyhole and the managed option portfolios are updated daily. So stock screener, feature trades, preferred trades, any option trade you see just on the regular stock page, those are updated once a day. All right, so Fatia says, if I own a stock trading at 250 and I want to trade a short straddle at a strike of 270 and the credit premium I get is 30, what is the risk on this trade? That is a little tough off the top of my head. So a short straddle is a short call and a short put. So yeah, it's not really like that. Yeah, you're essentially betting that the stock is going to stay relatively close to that 270. Because if it runs up, from there, you're going to have problems because you own the stock, so you won't be on the hook too long. If it goes down, it's where you really get hurt here is because, right, your stock is sliding and also the value of that put is going up. And so, yeah, if the premium you get is 30, I'm a little unclear on it. Is it 30 per share? Yeah, $30 per share on a option that's $20 out of the money doesn't seem exactly right. So I'm going to guess that's probably 30 per contract or 30 cents a share. So yeah, that's kind of a lot. Yeah, I mean essentially the long stock position gives you some protection to the upside in terms of the stock running higher. Most of the risk here is if the stock runs lower, but there's still, right, like, so if the stock makes it to 270, you're up $20 on the stock and you're out, whatever it was on the options, right? At 269, you're making a lot of money on the stock and some money on the options. Okay. All right. So it's $30 a share. All right. So yeah, that makes more sense. Just in terms of why you would even want to do this. All right. So yeah, the risks here is still to the downside, right? If the stock runs up, what you basically have is a covered call. If the stock runs down, what you've done is you've added a short put to the mix. So basically below 270, you're going to have to buy the stock, buy more of the stock, because you have a short put there. So, as the stock runs down, you're between 270 and 250. I guess you're pretty well covered just because of the credit you got. So your break even is probably around I guess it might be the 220 because that would be the net purchase cost. And so below there you start to lose money. But yeah, I don't know. I don't do a lot of straddles, and I don't know how many people. Yeah, it certainly makes it a thing that's more manageable in your portfolio in terms of combining it with a long stock position because you don't have an uncovered call in that way. But yeah, it's not really a thing that I do a lot of. All right. All right, so we got a question, why can't we view the options on the mobile app? Yeah, we essentially built a relatively limited mobile app just because we wanted to see if people would download an app and use an app. And right, we only built the Apple one at first. We have a pretty small development team. We're working on an Android app currently, and then we'll see what comes next. But yeah, you can still access the options stuff on the website. It's pretty easy to navigate in the browser. It's just not in the app because we didn't build it into the app. We have fewer option subscribers than we have stock subscribers, so we just kind of wanted to get something out there as opposed to the full featured app. Crypto is not in the app yet either, but we do have plans to add those things at some point in the future. I just don't have a timetable for it. All right. Like I said a second ago, yeah, this presentation is being recorded and we'll post it on the website probably tomorrow. You can find, yeah, we'll also send you an email when it gets posted. But you can find tomorrow's and other workshops in the personal finance section of the website. If you go to news and then personal finance, you can scroll through a bunch of them there. They're also on our YouTube channel if you are interested in finding it that way. Yeah, also, I think that's all the questions that are in here so far. If you have more questions, I'm blocked off the hour, so certainly happy to cover whatever it is you want. So Jerry said, not all those options. Do you have any stock tips for short and medium length uptrends? Yeah, I mean, so Jerry, we have our scoring system. Let's just pull up a stock. And we can talk about the different scores. So the overall score sort of combines everything. It's not necessarily a great metric to trade on specifically, but a good idea of what's going on with a stock overall. And so then depending on what it is you're looking for, we have these other scores, right? So sentiment is going to be our shortest term score. That looks at like the last 5 days of how a stock is trading. You can see Microsoft gets a relatively bullish rating. And if we look at, say, the last 5 days of trading for Microsoft, it's, yeah, looks like it's doing pretty well, especially in the more recent stretch of that last 5 days. Short-term technical is going to be the next sort of shortest in that regard, and that looks at the last month or so, which again, if we want to look at the last month, Microsoft hasn't been doing awesome. It's about break even for the month, but these scores outside of the sentiment score are percentile ranked. So what this means is Microsoft looks better than 84% of stocks over the last month, which if you look at the S&P 500 over the last month, it is considerably worse than break even. So yeah, that's how you can have a relatively high score on something that hasn't done great. Long-term technical looks at the last several months, we'll call it. About 6 or so is really where I think it's probably most effective. And again, right, like Microsoft went up and went down and somehow manages to be just a little bit below break even over the last 6 months. But it has a lower score here because the S&P 500 did better than break even. The average stock did better than break even for the last 6 months. Analyst ranking is exactly what it sounds like. We aggregate these rankings from Wall Street analysts. We look at the average recommendation and the price target. Microsoft does pretty well there in terms of 73. And then valuation is exactly what it sounds like. It's old school, right? Like, how much am I paying for $1 of earnings, and how much do I expect those earnings to grow? And then, excuse me, fundamental combines a little bit of the analyst ranking with the valuation. So no matter what kind of trader you are, trader or investor, right, there's something here for you. If you're real short term, you got your stock sentiment and your short term technical score. If you want to try to be, Warren Buffett, Peter Lynch kind of a thing, we got your analyst rankings and your valuation there as well. And then, the long term technical and things cover stuff in the middle. So Jerry says, I'm trying to guess if the downtrend is changing or not. Yeah, Jerry, I mean, like we looked at the beginning in terms of looking at charts, it's hard to tell. Yeah, it's hard to tell right now just from looking at the chart. It does look like there's a little bit of a bottom in on all the major indices, but really I think the news from the rest of the world is driving things much more than just technical analysis would really be useful. So yeah. Nadeem says, do we have a YouTube video to explain option trading? We do have some YouTube videos that explain some option trading. You can also find a lot of our stuff in the Help Center, options, portfolio, and strategies. Anything with this little icon next to it, there will be a video. And then, yeah, so options, portfolio, and trading. There's also the how-to videos. There's a lot of videos there. And then in the glossary, yeah, there's a few things here in the glossary that also have a video. But some of these are articles you can read also. So those are probably not, probably not a bad place to start. Option trades in the options screener, the individual stock pages, everything like that are updated once a day. All right. Seems like the questions have stopped coming in. You can ask us questions at any time. You don't have to wait for one of these workshops. Hit this help button. It sends us an email. We get back to most of them same day. Next day at the latest. You can also give us a phone call. The phone number is down here in the bottom of the website. We answer the phone during East Coast business hours. Other than that, the next one of these sessions will be in 3 weeks, which I believe is like April the 6th. Let's see here. Yeah, April the 6th. Look out for that recording to be sent to you tomorrow. But yeah, other than that, thank you for subscribing to Investors Observer. Thank you for coming and listening to me talk. Yeah, I will talk to you next time. Thank you.